Welcome to the EXP Group's discussion of CIMA Paper P1, Performance Operations. Today we just want to cover, within the investment appraisal topic, a couple of issues regarding inflation and taxation that we need to understand when doing discounted cash flow calculations. Exam questions could involve the appearance of inflation. So when we're doing cash flow projections, we have to represent the impact of inflation on the numbers. Now, basically, the inflation represents price increases that reduce the purchasing power of money. So if we have inflation of 7% in a year, $100 in hand today is effectively equivalent to $107 in hand 1 year from today. In other words, both amounts in the respective time, in this case, t equals 0 for the $100 and t equals 1, both amounts will buy the same amount of goods. It's useful to be able to calculate the rate, the nominal rate, and convert this into real interest rates for the purpose of discounted cash flows. We call this the Fisher formula, and the formula here is based on multiplying a real rate discount factor by the inflation rate to get the nominal rate. In other words, if we had an expected real return on our money, a real rate of 5%, and there is 10% inflation in the system that's going to eat away at the value of my money, I would have to be able to place my $100 for 1 year at a rate of 15.5% so as to be able to achieve a real rate of 5% increase. In other words, I would have to receive after 1 year $115.50. When we discount cash flows, just keep in mind that if we have cash flows that are expressed in real terms, then we have to use real discount rates. And if we have nominal cash flows, then the nominal discount rate will be appropriate. Typically in exam questions, we will have different rates of growth for different categories of costs. Wages, for example, may go up by a different rate than raw materials. We have seen, for example, that in the jobless recovery in the current economic crisis, that wages, unemployment being quite high, wages growth will have been more reduced, but with the recovery, raw materials costs have gone up quite substantially. So this is not unusual to see different differential rates of growth. When we have this phenomenon, the forecasting of cash flows is best done in nominal terms. Let's move on to taxation issues. Taxes represent a cash flow when we do our projections. We have to calculate the impact of taxes accurately. Let's have a look at the impact, for example, of a company investing $50,000 in equipment, and they expect net operating revenues in cash terms of $35,000 over the next 3 years. So here are the cash flows, here are the taxes that are operating on that revenue, and this is our net operating revenue after tax. There's an additional tax impact, and that is on capital allowances for equipment, and we want to show this in a separate subsidiary working, in a separate calculation, based on a description of how the tax operates. The capital allowance is available in this case at a 25% rate on reducing balance basis. And we will have a machine that's scrapped at the end of 3 years for $20,000. What we have here is now a summary in cash flow terms of the impact of the written down allowances on the asset. We can see here that the investment is $50,000, the disposal value in year 3 is $20,000, and we can see here for years 1 and 2 are the written down allowances that are generated on the assets, calculated at 25% of the reducing balance, and the corresponding tax relief, which is, if we have a tax rate of 35%, is going to be 35% of the written down allowances. Now these numbers in bold are the actual tax savings which we derive in the calculation of the written down allowances, and these are relevant from a cash flow point of view. In other words, we're going to transfer those numbers down here which represent tax relief on our asset. So the projected cash flows for our project, as reflected in this example, show us the operating part of the cash flows up above. That was the net operating revenue less the tax on the operating revenue and net operating revenue after tax. We can see it's the same for each of the 3 years, 22,750. Here's the year 0 investment made, 50,000, and now we have to add back the tax relief generated due to the written down allowances, and of course in year 3 we realized the disposal of the equipment for 20,000. Put that all together and we end up with our net cash flows. This is the cash flows now which have to be discounted at the appropriate discount rate in order to come to a determination of whether we have a positive or negative net present value on the project. In other words, whether it's acceptable or not. We have another method here called the discounted or adjusted payback. We were in an earlier discussion, we talked about the simple payback method. What the adjusted payback method does is it discounts the future cash flows to present values, and then calculates when the initial amount is effectively recovered. So in this case, we can see that the simple payback period would be after 2 years. In other words, 100 plus 100 equals 200. But the discounted payback period takes a bit longer, pushes us into year 3 because we're adding back discounted values, 90.9 plus 82.6 plus a little bit of year 3's cash flows in order to equal $200. And finally, the asset replacement decision is another technique which is part of investment appraisal, which allows us to determine on what basis or what frequency we should be turning over or replacing our assets, whether on a 1, 2, 3 or more year cycle. And in order to do this, we have to have an underlying situation which gives us operating costs, resale values, and initial investment costs. And then what we have here, and the candidate is invited to work through the different scenarios. What's presented here is running the cash flows under several scenarios. The first scenario being if we replace the equipment after 1 year, what the impact is going to be. What the impact will be if we replace the machine after 2 years. In other words, every 2 years we replace the machine. And the third scenario is replacement after 3 years. Now, one can see here, one can see that the simple comparison of the net present values of the 3 scenarios will not be decisive in determining which scenario is the least cost for the business, because the 3-year cycle scenario has a net present value of 20,000 in terms of cost, which is going to be higher than if we were to look at a 2-year scenario or a 1-year scenario. So we have to bring everything to a common basis to make the comparison. That common basis is provided by dividing the net present value by the annuity factor in each of the scenarios. This is a 1-year annuity factor, this is a 2-year annuity factor, and this is a 3-year annuity factor. And what the impact is of making this adjustment is that we now have a number, a magic number that pops out, 9,501, which is the amount, the cost to us every year. It's a perpetual cost, equal annual cost of replacing the equipment after 1 year. This can be compared with 9,949 because 9,949 represents an equal annual cost into perpetuity of the 2-year scenario. So these two can be compared with each other, as can the third scenario, which is 8,394. This, in fact, becomes the least cost to the company of the 3 scenarios, and therefore the most financially advantageous cycle in which to replace the equipment is on a 3-year basis.